This is question number 9 of homework 1, chapter 2, problem 2-21. During 2017, Reni's umbrella corporation had sales of $700,000. Cost of goods sold, administrative and selling expenses, and depreciation expenses were $500,000, $90,000, and $95,000 respectively. In addition, the company had an interest expense of $94,000 and a tax rate of 35%. Ignore any tax loss carryback and carry-forward provisions. So this quantification here simply tells us if the taxable income or earnings before taxes turns out to be negative, then the tax is simply 0 rather than a negative number. So that's what this quantification here means. Suppose the company paid out $58,000 in cash dividends. Is this possible? If net capital spending and the change in net working capital were both 0, so immediately this means if we go to our lessons, so session 1, pull out my lecture slides, can see that the cash flows, the cash flow from assets is simply the sum of operating cash flow, not the sum, but the difference between the operating cash flow and the change in net working capital and the capital spending. So that's basically yeah, so this is a cash flow from assets. Basically, we just pull out the post lecture slides of session 1. So the cash flow from assets equals operating cash flow minus this delta here means the change in net working capital and minus the net capital spending. So from that, go back to our setup. This means if net capital spending and the change in net working capital were both 0, so that simply tells us the cash flow from assets is simply equal to operating cash flow because these two terms are both 0. So that's what this sentence tells us. And if no new stock was issued during the year, so this information can be used immediately if we are familiar with the content of this session, because the cash flow to shareholders depends on two inputs. One is the issuance of new equity, and the other is the dividend payment. So you see that cash flow stockholders is dividend and the repurchase of stock, or more precisely, this should be the net issuance of stock. But here it only has the purchase of the stock. That's why I wrote as repurchase of stock. So in this case, no new stock was issued during the year. So that tells us the cash flow to stockholders is simply so let me write down here, the cash flow. First, the cash flow from assets, as we said, that equals operating cash flow, because the other two terms, the change in net working capital and the net capital spending, this is 0, so this is 0, hence CFA is simply OCF. So as far as we read the setup, we can immediately gather these results. And secondly, because we were told that no new stock was issued during the year, so cash flow to stockholders that equals dividend, right? This is from a stockholder's perspective. So if the so when the firm pays out a dividend for stockholders, it's positive cash flow. That's why it's this is a plus. And then there's net issues of stock. So when the firm issues stock, issues new equity, for the firm, they get cash flow from the investors, but for investors, because the cash flows are paid out of their hands, so for them, it's negative. That's why you have the negative minus the net issuance of stock. And if the firm, they purchase the existing stock, it's just the other way around. That's why you have this net. Net here means it's the new issuance of stock minus the purchase of the existing stock. So that's the net. So in this case, the no new stock was issued during the year. And there's no information about the purchase of the stock, so we can safely assume that's also 0. So that tells us, based on this equation, cash flow to S, to stockholders, that simply equals dividend. So far, as we read along this setup, we can gather those results. But the question is asking us, what was the net new long-term debt? Net new long-term debt. So here we are not told about the balance sheet, right? In general, we are given 2 years balance sheet, 2 times balance sheet, so we can figure out the net new long-term debt very easily by taking the difference between the 2 years long-term debt. But in this case, you cannot use that approach because the balance sheet is not provided. How can you solve this question without the balance sheet? So the trick here is to use the so-called balance, the cash flow identity. What that means is cash flow from assets. So why this is suddenly goes so below? Let me write down here. Cash flow from asset, that equals cash flow to stockholders plus cash flow to creditors. So this is called cash flow identity, and you can find that also in my lecture slides, also in the book. So cash flow from assets equals to cash flow for, here B stands for bondholders. Here I use the creditors, it's the same. Plus cash flow to stockholders. So that means if we can get cash flow from assets, that's here, right? That's simply operating cash flow in this special case. And cash flow to stockholders, that's simply dividend. So if we can get to this two numbers, we can use this equation to figure out cash flow to creditors. That's simply to creditors equals cash flow from assets minus cash flow to stockholders. So why I care about this cash flow to creditors? because if you go to my lecture slides again, cash flow to creditors can also, actually this is the most common approach given the information from the financial statements. Cash flow to creditors is the sum of in this case it's the sum, but in most cases it should be the difference. It's the interest minus net issuance of new long-term debt. So again, this also equal interest minus net issuance long-term debt. Why this is the case? Because if the firm pays out the interest, for the firm it's an expense, but for the creditors it's a income. So that's why interest enters as a positive value here. But when the firm issues new long-term debt, that's the net issuance of long-term debt, then for the firm they collect money from the creditors, but for the creditors they pay money, they pay cash flow to the firm. So for them it's negative. That's why here it's minus sign. So it's interest minus net issuance of long-term debt. That's why we care about cash flow to creditors, because here we have this net issuance long-term debt. That's what's asked of this question. What was the net new long-term debt? So that tells us if we can figure out the cash flow to creditors, because we know the interest, right? That's directly provided by the setup. Then we can figure out the net issuance of long-term debt based on this equation. So that's basically what we can gather from this input here. Okay, so let me use Excel to solve this question. For me, that's the most convenient tool, but you can feel free to use other tools like financial calculator or simply a scientific calculator. So we start from sales. So what am I doing here? Because I want to figure out the cash flow to creditors, and in order to figure out cash flow to creditors, I need to figure out cash flow from assets and cash flow to stockholders. And in order to figure out cash flow from assets, I need to figure out the operating cash flow, right? The operating cash flow, because they are equal the same. They are equal here. So that's why I start from the income statement. So sales. And sales is 700,000. 700,000. And cost of second item on the cost of goods sold. COGS. That's the 500,000. And the next one is the administrative and selling, AS. That's simply the 90,000. And depreciation. That's the 95,000. Yeah, I have to double check, because if you miss 1 0, the number will not be correct. 500,000, yes. So based on this input, I can calculate EBIT, which is simply the sales minus cost of goods sold minus administrative and expenses and selling expenses. Actually, I should call this after that. And then finally minus depreciation. So I should call this yes, AS. Yes, it's administrative and selling expense. Okay, so I think I got it right. So EBT here, EBIT is a positive number. So the next item is the interest, right, on the income statement. So interest here is 94,000. And you can see that EBIT here is smaller than the interest. So that means the taxable income, which is also called EBT, earnings before taxes, will be a negative number. And that's why that quantification we just read here, ignore any tax loss carryback or tax carry forward provisions will be useful here. So tax rate is 35%, but in this case the tax rate doesn't matter because the taxable income is a negative amount. The taxes without loss carry forward or carry back will be 0. So that means net income is simply equal to EBT. Okay, so another question goes on, the dividend, cash dividend. It's a positive amount, right? 58,000. The question, the first part of the question is asking, is this possible? So on surface, if you only look at this 1 year's number, net income, because net income is negative, so where does the cash flow come from? Because the firm wants to pay out a positive cash, positive dividend, right? So, but remember, the firm is a cumulative entity. So this one single year's number doesn't tell us how much cash the firm has. The firm may have more than sufficient, more than $58,000 on its cash balance. Hence, it will still be able to pay this positive dividend, even though the net income is a negative amount for this specific year. So here we don't have to answer that part because the only blank here is net new long-term debt. But if we do, the answer to this part of the question is yes, this is possible. And so now we can calculate basically, remember, as we said, the purpose of doing all this is trying to figure out the operating cash flow. So operating cash flow is we start from EBIT, remember, and then we add back depreciation because depreciation is not a cash outflow. It's just a book value of the marking down of a specific equipment or fixed assets, other fixed assets. So it's not the firm doesn't have to write a check on the depreciation. That's why here we are trying to figure out the cash flow, so we have to add it back. But then we have to deduct taxes. In this case, that's doesn't make any difference because tax is 0. The operating cash flow is this amount. So this also tells us cash flow from assets is the same, right? We just go back to our notes. Cash flow from assets is the same as the operating cash flow. So next job is to figure out what is the cash flow to stockholders. And we also know that cash flow to stockholders is simply the dividend, right? So the cash flow to stockholders is simply the dividend because based on our analysis. So now I can calculate cash flow to creditors, CFC. Or in my notes, in my lecture slides, I use B. So to be consistent, I just yeah, keep using B, cash flow to creditors or to bondholders. So by the identity, cash flow identity is simply the cash flow from assets minus cash flow to stockholders. So this is the cash flow to creditors. So now, last part of the job is to calculate this net issuance of long-term debt. And based on this equation, it's simply because cash flow to creditors is simply interest minus net issuance of long-term debt. So net issuance, net, I just will be short for net long-term debt. That's simply equal interest minus cash flow to bondholders. Right? If you move this to the other side and move the cash flow to creditors to this side, and that's how you can get this expression. So, and then we just net issues long-term debt. It's simply the interest, right? Interest here minus the cash flow to bondholders. So the answer here is $42,000. So let me put down this, let's check my answer. Good job.